Hello everyone, Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now lately I've seen a lot of headlines in the media asking or debating what's really a pretty simple question, which is why aren't oil prices much higher than they are right now? I've also had some questions from readers over the past couple of months along a similar line. After all, West Texas Intermediate WTI oil closed at $89.47 a barrel on Friday, and front-month Brent oil futures closed at $96.78 a barrel. Now these are the main US and global benchmarks for crude respectively. So take a look. This chart shows front-month closing prices for Brent, that's the blue line, and WTI, which is the red line, over the past year. As you can see, we are well off the closing highs we saw back in March and April for both benchmarks. The absolute closing high for Brent on this basis was $118.35 a barrel on March 31st, and for WTI, it was $112.95 a barrel on April 7th of this year. So in both cases, we're sort of $20 to $23 a barrel off the highs from about 4 months ago, despite the collapse of the Memorandum of Understanding and ceasefire between the US and Iran, and a new closure of the Strait or Hormuz, and even a potential escalation. Now this simple cartoon map shows the Strait of Hormuz, which is the choke point we've been talking about for 6 months now. Historically, some 20+ million barrels a day of oil and refined products transit this strait. However, Saudi Arabia has been able to divert as much as about 7 million barrels a day of exports via the port of Yanbu here on the country's west coast. So you can see that on the map. It's on the Red Sea. Now, most of the oil exported from that terminal would normally move south through the Bab el-Mandeb Strait there that leads to the Gulf of Aden and ultimately moving east to Asian markets. However, the Houthis in Yemen have received military and technological support from Iran. That includes anti-ship cruise missiles, ballistic technology, long-range attack drones, and unmanned explosive boats. And the Houthis have been attempting to frustrate traffic through this choke point, Bab el-Mandeb, as well. Now, as you can see, it is possible to sail north and send oil through the Suez Canal as an alternative. However, there are problems with that, including most of the oil exported out of Yanbu isn't going to Europe, okay? It's going to Asia. So after transiting Suez and entering the Mediterranean, it needs to take a much longer voyage. First to the west, out of the Mediterranean, then south around the Cape of Good Hope, around the southern tip of Africa, and finally back east towards Asia. Very circuitous. That's a much longer and more expensive trip. Also, typically, most Saudi oil destined for China or other Asian buyers would be loaded onto what we call very large crude carrier or VLCC ships. VLCCs can't transit the Suez Canal fully loaded without grounding, running aground. So these VLCCs from Saudi would have to offload part of their cargo to the Sumed pipeline, right, which is right sort of paralleling the Suez Canal. Then the VLCCs transit the Suez Canal partly loaded to avoid grounding, then reload the oil there once they're through the canal and into the Mediterranean. So that Sumed pipeline only has capacity of about 2.5 million barrels a day. And this entire process takes additional time to load, unload, and then reload, right? And can quite easily lead to long vessel queues, lines, to try to get through the Suez Canal. In other words, you could argue the current disruptions to global oil trade are even more severe than they were back in March and April, because it's no longer just the Strait of Hormuz, but also now Bab el-Mandeb. Now, I suppose it's logical to wonder why, given that, oil prices aren't even back to those springtime highs. Now, of course, the media always wants to default to macro narratives, right? Like demand destruction, or sudden electric vehicle displacement of Chinese or global oil demand, because those are pretty simple, easy to understand, top-down stories. People like that. However, that's not what's actually happening. As I noted in a Sunday deep dive a couple of weeks ago, global oil demand hit record highs over 103 million barrels per day in 2025, and this whole conflict and resulting disruptions to tanker traffic through the Strait of Hormuz, well, that started in March, just 2 months into 2026. Even if they wanted to do so, there's just no way for China or any other global economy to quote-unquote transition away from oil quickly enough to offset the largest crude oil supply disruption in history. Yet, it's undeniable that you're just not seeing the dramatic consequences of all these supply disruptions, now Bab el-Mandeb too, right? In front month oil futures for either Brent or WTI right now. And front month oil futures seem to be the main focus of the media and, to be fair, most casual energy market observers. However, the petroleum market is actually very tight right now, and you are seeing it, just not in oil, at least not yet. The supply tightness is very visible in the refined products markets. The prices of gasoline, diesel, jet fuel, even plastics and petrochemicals. And that's ultimately what matters even more to the consumer and the global economy. Just remember, as a consumer, you and I, we don't buy barrels of oil. We buy gallons, or in some places, I guess, liters of gasoline or diesel. Or maybe you buy an airplane ticket, right? And you pay for jet fuel, either baked into the fare or as a surcharge. Now, as I'll explain in just a moment, absent a handful of fading artificial headwinds for oil, the current level of gasoline and diesel prices suggests WTI will easily jump to $110 to $120 a barrel. Here's the chart that tells the real tale. Now, this is the Gulf Coast 3-2-1 crack spread. I'm using daily data here for front month WTI crude oil futures prices, US traded gasoline futures, and US traded ultra low sulfur diesel futures. To help account for differing futures roll schedules for these products and some short-term distortions like those negative oil prices we saw back in 2020, I am actually reporting the 10 trading day, that's a 2-week, moving average of the 3-2-1 crack spread in this chart. And as you can see, this crack spread has been hitting record highs this summer. The 3-2-1 crack spread is a measure of refining profit margins. As I've explained in prior posts and videos, refiners are one of the only significant energy-related sectors that does not directly benefit from rising oil prices. These companies are best thought of as manufacturing firms. And like all manufacturers, refiners are in the business of buying raw materials and turning them into products they can sell to consumers or businesses. In this case, refiners buy crude oil as feedstock for their facilities, right? And use that raw material, oil, to produce a long list of refined products. The two most important products are gasoline and diesel fuel. So the 3-2-1 crack spread that we're looking at here is calculated using NYMEX traded futures as follows. Now, the prices on this slide are the closing prices last Thursday, July 23rd. I selected that date because that was the day last week when oil, gasoline, and diesel prices all closed at their highest levels in July. So the 3-2-1 crack spread is the profit margin from turning 3 barrels of oil into 2 barrels of gasoline and 1 barrel of diesel. The price of gasoline on Thursday, September futures, was $3.32 and a bit per gallon. Each barrel is 42 gallons. So 2 barrels is 84 gallons of gasoline. Little simple multiplication there. It's worth $279.23. Diesel cost $4.24 roughly per gallon. So 1 barrel of diesel, again, that's 42 gallons. Well, again, multiplication is worth $177.95. And then from that, we must subtract the cost of 3 barrels of oil. Again, the raw material to produce these products. Oil is priced in dollars per barrel conveniently, so $92.19 per barrel on Thursday. That's multiplied by 3, that's $276.57. Add all that up, the gasoline and diesel value minus the cost of the oil, and we get a crack spread for converting 3 barrels of oil into 2 barrels of gasoline and 1 barrel of diesel of $180.62. One more step. We have to divide by 3 to get the 3-2-1 crack spread because it's conventionally quoted on a per barrel basis. In this case, that's $60.21 per barrel. So here's how it's calculated. Let's flip back to the chart of the crack spread since 2006 here. As I noted earlier, the 3-2-1 crack spread this year has been hitting record highs, with the 10 trading day moving average recently spiking into the high 60s per barrel, up near 70 bucks a barrel. We've never seen that before. And it's not just the US. Similar measures of crack spreads in Asia and other major markets have also hit record highs in recent days. So why is this happening? Well, think about the calculation I just outlined. Refiners make money from the relative prices of oil, gasoline, and diesel. They make more money when the prices of gasoline and diesel rise faster or fall slower than the price of oil, because crude oil, in this case WTI, is their main cost center. Here's another way to look at it then. This chart shows the percentage change in the prices of WTI crude oil, gasoline, and diesel prices since June 30th, 2025, basically the past year. As you can see, oil prices are up only 37.2% over this time period, while the price of gasoline, it's up 63.3%. Even worse, the price of ultra-low sulfur diesel soared 78.22%. That's why refining profit margins, crack spreads, have surged to record highs. Now, for this 3-2-1 crack spread to compress towards more normal levels, right? Either the prices of products, gasoline and diesel, must fall, or the price of oil must rise, which would boost refiners' costs. Or it could be some combination of those two things. Probably that's the most likely outcome. Now let's frame this calculation in a different way. For the entire period covered by my chart of the crack spread, more than 20 years of data, the average 3-2-1 crack spread is $20.29 per barrel. The standard deviation is $10.50 per barrel. So the current 10-day simple moving average of the crack spread, which is $67.34 per barrel, well, it's about 4.5 standard deviations above that long-term mean level. Given the current level of gasoline and diesel prices, if crack spreads were to contract to a still stretched 2 standard deviations above the long-term mean, so that would be about $41 a barrel for the crack spread, we'd need to see WTI crude oil trade at around $112 a barrel to get there. To get to a crack spread a full standard deviation above the long-term mean, that's a crack spread near 31 bucks a barrel. Oil prices would need to jump to around $122 or $123 a barrel. And to get to a crack spread of 2029, that is the long-term average, we'd have to see WTI trade at over $130 a barrel at the current level of diesel and gasoline prices. 2 points. First, the current level of diesel and gasoline prices implies much higher oil prices in a more normal environment for crack spreads. As I said, we're at record highs and more normal level. And second, if end user demand destruction were taking place, as many in the media have claimed, whether from macro weakness in the economy or electric vehicle adoption, then product prices, gasoline and diesel, would be falling more in line with crude or with crude. Instead, retail and wholesale product prices remain resilient, keeping crack spreads near those record highs. Simply put, the reason that this relationship between product prices and oil is so, out of whack, the reason crack spreads are soaring has to do with a handful of specific market factors and political choices that are artificially depressing the price of oil and inflating, in some cases, the prices of refined products. Now, in the interest of brevity, let's just hit a couple of the bigger factors, starting with this. This chart shows global refinery capacity broken down by some key countries and regions of the world. As you can see, while US refinery capacity is off its highs from back in 2019 or so, that's the darker blue line. The modest decline pales in comparison to what we've seen in the UK and the European Union, where refining capacity has just collapsed. The UK is the purple line and the EU is the blue line here. At the same time, notice that Middle Eastern countries have dramatically increased their refining capacity, adding more than 2.5 million barrels a day of capacity over the past decade alone. Of that, Saudi Arabia has the most capacity in the region at 3.29 million barrels a day, followed by Iran, interestingly, at 2.46, Kuwait at 1.43 million barrels a day, Iraq at 1.39, and the UAE at 1.26 million barrels a day. Now, due to the loss of domestic refining capacity, Europe and the UK have grown more dependent on imported refined products and chemicals from regions that have more refining capacity, including, of course, the United States and the Middle East. Indeed, the United Kingdom now imports a staggering 50% of its diesel fuel and 80% of its jet fuel needed to meet domestic demand, such as, for example, London's Heathrow Airport. Of course, the recent conflict in Iran and the closure of the Strait of Hormuz have caused significant interruptions to refined product supply from many Middle Eastern countries. Simply put, refined product prices in Europe have to rise to attract exports from the US because Middle Eastern supply is largely choked off. That in turn pulls US prices higher. That's basically the market's way of trying to keep US refined products at home rather than exported. Indeed, US refined product exports have soared since the start of Middle Eastern supply disruptions. In April 2026, the last month for which we have data from the Energy Information Administration, US total exports of finished petroleum products reached 3.567 million barrels a day, up 28.5% from April 2025, the same month last year. US distillate fuel oil exports, which is mainly diesel, that jumped 37.2% year over year. And jet fuel exports hit a record high in March 2026, and we're still up 76.7% year over year in April. Back to this chart. As you can see, Russia also has significant refining capacity of over 6.7 million barrels a day. And in 2021, prior to the invasion of Ukraine, the country exported some 2.8 million barrels a day on average of refined products. However, estimates are that some 40% to 50% or more of that capacity is now offline. That's 2+ million barrels a day of lost capacity, due largely to Ukrainian drone strikes and, a lesser extent, some sanctions have cut off their access to key parts and equipment. Now that brings us to China. As you can see, China has the largest refining capacity of any country in the world at over 18.8 million barrels a day. More importantly, China has spare refining capacity. This chart shows total Chinese refining capacity as a red line, total throughput through Chinese refiners as a blue line, and the spare capacity as a green column below the chart. Of course, we would not expect any refinery anywhere in the world to operate at 100% of capacity through the entire year, and this is annual data. However, in 2025, total Chinese refinery capacity utilization, the percentage of that total theoretical maximum capacity utilized on average through the year, was only about 78.3%. Now the equivalent figure for the US, a little over 90%. Simply put, growth in Chinese refining capacity has exceeded growth in Chinese throughput and oil demand in recent years. Okay, that's a sign that Beijing has been deliberately building spare refining capacity. So what's the strategy here? Well, China is extremely import dependent. In 2025, China imported somewhere around 75%, 3/4 of its oil and 40% of its natural gas supply. China can and does take steps to diversify its energy sources, such as building out nuclear, solar, wind, and hydroelectric power. The country also relies heavily on its massive domestic coal supply. Indeed, let's put this in perspective, coal accounts for 56.9% of China's total primary energy supply, compared to all non-hydroelectric renewables combined, including wind and solar, at 6.1%. And yes, China is aggressively pursuing electric vehicles to slow growth in oil consumption specifically. That's the major fuel for which it is most import dependent, or even to try to bring down oil consumption over time. Those are all logical, strategic steps for an import dependent country like China. However, the simple mathematical fact, right, is that none of these are total replacements for oil and natural gas. Light passenger vehicles account for only around a quarter of global oil demand. The rest goes for heavy freight transport, air transport, and crucially, petrochemicals production. Most of these other major uses for oil are difficult or impossible to replace with electric vehicles. So China has formed a sort of demand-side version of OPEC, right? China doesn't report exact figures for its oil storage capacity or how much it pulls out of or adds to inventories over time. However, it's estimated that China's total onshore storage capacity is between 1.3 billion and 1.5 billion barrels, including up to 500 million barrels of pure strategic reserves like the US SPR, with the rest held as commercial inventories. Now in China, unlike the US, the line between a strategic government petroleum reserve and commercial inventories, well, it's very blurred, right? Because some 80% of commercial reserves are owned directly by state-owned energy companies. And Beijing can control the rest via import and export controls and mandates. China has been taking advantage of low oil prices in recent years and sanction discounts on barrels from places like Iran and Russia to aggressively fill its oil inventories at discounted prices. Much as Saudi Arabia is the world's largest oil exporter and can influence prices by varying the amount of oil it produces and exports, China is the world's largest importer and can influence prices by varying the amount of oil it imports. The massive scale of Beijing's reserves is what facilitates this. When prices spike, as they did back in March and April, China can simply step back from importing oil and draw down its massive onshore oil inventories. That is why they built this massive reserve. According to IEA, Chinese crude oil imports plummeted 4.6 million barrels a day between February and May of 2026, and the country pivoted to drawing down its vast onshore reserves as an offset. A second piece of this puzzle is that spare refining capacity I just outlined, right? In March, Beijing issued a directive halting new diesel, gasoline, and jet fuel export contracts, and exports subsequently collapsed by around 60%. In 2025, gross Chinese refined product exports totaled 54.5 million metric tons. That's about 1.12 million barrels a day, with more than half of that heading to other Asian nations. In essence, China is the world's swing importer of crude oil. By building up a massive strategic reserve with plans to make it even larger, China is able to dampen the impact of short-term spikes in oil by reducing imports. And because it is the largest spare global refining capacity right now, it can also impact the prices of refined products in Asia, but also globally, by either restricting exports or issuing new export licenses. This both allows China to shelter its domestic economy from volatility in oil prices and influence the global traded price of oil by acting as a sort of counterweight to OPEC. Operation Epic Fury has impacted the supply of both oil and refined products because the Middle East is both a sizable exporter of crude oil as well as, I mentioned, a growing exporter of refined products. All things equal, a decline in supply relative to demand will force prices higher. It's just the market's way of rationing demand when there's a supply shortage. However, all things are not equal because three main factors have helped offset the loss of Middle Eastern supply of oil specifically, while providing far less supply relief for refined products. First, Strait of Hormuz bypasses. Saudi Arabia's East-West pipeline was pre-war capable of moving around 5 million barrels a day of oil to Yanbu on the Red Sea, right? But they've converted some natural gas liquids pipelines to crude oil service, so Saudi was able to expand that bypass to 7 million barrels a day. The United Arab Emirates, UAE, Habshan Fujairah pipeline is able to move on the order of 1.8 million barrels a day of oil from Abu Dhabi's key oil fields to the Gulf of Oman, and that also bypasses the Strait of Hormuz. So that's maybe 8 to 9 million barrels a day of total crude and refined product exports that can bypass Hormuz, compared to the normal flow of roughly 20 million barrels of crude and products through the strait. However, there are no regional refined product pipelines that can get around the strait, right? These are all oil pipelines. Now, the exception to that is Saudi Arabia does have a major refining center on the Red Sea coast at Yanbu, and is able to process some of the oil that it gets to the West Coast into products and export those products via the Red Sea, right, to Europe or Asia or wherever. However, effectively, that's only around 1 million barrels a day of total refined product exports that's able to bypass the strait. So roughly speaking, on a normal day pre-conflict, you'd have 15 million barrels of crude oil and 5 million barrels a day of refined products going through the Strait of Hormuz. Saudi and the UAE have alternative export routes to facilitate the export of, let's call it 7 or 8 million barrels per day of crude oil, right? However, there's a Hormuz workaround for only around 1 million barrels a day of Saudi refined product exports via the Red Sea. Now, from a proportional perspective, that leaves a larger percentage of refined product exports from the region stranded in the Persian Gulf. As we outlined earlier, China was able to reduce its oil imports by more than 4 million barrels a day by drawing down commercial and strategic reserves built up over the past few years. So that's a further volumetric offset for the loss of oil export volumes through the Strait of Hormuz. Now, that helped ease the supply-demand balance from March through June of this year. At the same time, China's refined product export ban tightened the global market for refined products. So by reducing their imports of oil, they sort of loosened the market for oil, but by reducing their exports of refined products, they tightened that market, right? So because they took the world's only spare refining capacity out of the market. Note that while oil is stable indefinitely when stored underground, which is how it's done, that's not the case with refined products like diesel and gasoline. So that makes it impractical to build a vast strategic product reserves, right? In the same way countries like China and the US build strategic petroleum reserves for oil. The closest workaround to that problem, that physical problem, is China's strategy of deliberately holding spare unused refining capacity, which is what they've done. Now, US and IEA strategic reserve releases are another countervailing force. The US, UK, Germany, Japan, Canada, and other developed nations agreed to a massive strategic release of oil reserves in the early days of this conflict to help offset the loss of barrels stranded in the Gulf. The US was the largest signatory to this deal, 172 million barrels from the US Strategic Petroleum Reserve out of a total headline amount from all those countries of 400 million barrels. Now, the SPR is already severely depleted. This is a problem. At the end of President Trump's first term, right, there remained around 640 million barrels in the SPR. President Biden drew down SPR by over 243 million barrels, and so far in this term, President Trump has released an additional 83 million barrels from SPR. Today, the SPR holds about 311.5 million barrels. So that's less than half the level at the end of 2020. And in fact, we're back to levels we haven't seen since 1983. According to the latest weekly report from the EIA, total US commercial crude inventories are around 6% below the 5-year seasonal average. Not great, but not shockingly terrible either. However, right, commercial crude inventories is a measure that excludes those volumes held in SPR. So when the government releases oil from SPR, it moves from the SPR into that commercial inventory volume. So this chart I'm showing you here shows total US oil inventories, including SPR, since early 2024 against the 5-year seasonal average, 5-year seasonal max, and 5-year seasonal minimum. As you can see on this basis, total US oil inventories are some 17.7% below the 5-year seasonal average, and more than 10% below the prior 5-year seasonal low. SPR releases are finite. And at around 311 million barrels a day, the SPR is getting close to some of its operational floors. Further, the Department of Energy has structured the current release as a loan or an exchange, meaning that the companies receiving SPR volumes must pay back those volumes in future with a premium amount. Now, this differs from the 2022 emergency SPR release under President Biden, which was structured as a cash sale rather than a loan. The idea at that time, right, stated by the Biden administration, was that oil would be sold out of SPR for cash at high prices, sort of $95 a barrel in 2022, then repurchased at lower prices once supply disruptions eased. Back then it was the Ukraine-Russia conflict. The ultimate outcome was that the Biden administration only bought around 59 million barrels to refill the SPR compared to the $180 million drawdown initially announced. Now, to be fair, the Biden administration did work with Congress to cancel 140 million additional mandated sales, barrel sales, of SPR volumes scheduled for between 2024 and 2027. But those were sort of paper barrels. For this current release of 172 million barrels, though, the terms of these loans require companies to ultimately pay back over 200 million barrels to SPR. So essentially refilling the reserve without the need for the Department of Energy to spend money to buy oil. In effect, while SPR releases today increase supply and will tend to push down oil prices, there's a direct contractual obligation to remove even more supply from the market, the commercial market, commercial inventories in coming years. The bottom line is that all three of the levers that softened the blow of soaring oil prices earlier this year, SPR releases in the West, China's import strike, and Hormuz workarounds, artificially and temporarily loosened the supply-demand balance for oil. However, the real underlying shortage showed up in refined products markets. As I said, however, this is not sustainable. This month, China has authorized additional refined product exports to Asia, which should help cool prices for refined products a little bit. However, the government export licenses come with a caveat, right? Refiners must maintain product inventories at their late February 2026 levels, pre-war levels. Effectively, that means the refiners must import new barrels to grow their product exports. China also stepped back into the oil market directly with some opportunistic buying, importing, as prices came down in June and July. However, with Brent oil prices spiking back towards $100 a barrel, it's quite likely China will once again begin drawing down its reserves to reduce imports and avoid driving up global oil prices. In effect, several of the key offsets that restrained oil prices since the start of Operation Epic Fury are now fading or soon will fade. The Houthi threat on the Red Sea risks hampering Saudi Hormuz workarounds via the Bab el-Mandeb Strait. Meanwhile, Western SPR releases led by the US are limited by dwindling reserves and operational realities. Only the China import strike lever remains. However, this will also act as a floor for oil prices, since Beijing is likely to step up imports should we see any dips in oil prices back to that $70 or $80 barrel range, because they want to opportunistically refill their reserves. So what are the implications of all this? Coming into this year, refiners, particularly Valero Energy, symbol VLO, were one of my favorite sectors within energy, because I felt that investors underappreciated the tightening global refining capacity story I just outlined, increased import dependence from countries like the UK or other countries in Europe, in the European region. These stocks have soared. These refining stocks have soared, including Valero. Since we first recommended it in our Energy and Income Advisor service back in June 2020, in fact, Valero is up close to 500%. With refining margins at record highs and investors aggressively bidding up the stocks, we've recommended selling out of Valero across all our products, including the Energy Bulletin Top 10 portfolio actually a little earlier on this year. Valero is still a great company. We just don't see the value there after this big run. Now is the time to pivot, in my view, to the oil producers and oil services stocks. As some of the forces artificially restraining oil prices fade, a potential disruption to Saudi oil exports through the Red Sea, and eventually a slowing in US SPR releases, I believe oil prices are likely to rise and close some of that gap with refined products. Unlike refiners, producers would benefit from that. Refiners would see declining margins, crack spreads, producers would benefit. Now, the biggest risk I see is that refined products prices also remain extremely elevated, to the point that we begin to see actual demand destruction. That's the sort of outcome that could spark a global recession. Now, I'm not predicting that, but it's something that to keep on your radar screen. So thanks for listening. I hope you enjoyed this week's Sunday Deep Dive. If you enjoyed this video, please drop me a like or a comment, and you can subscribe for free to make sure you receive this weekly video and my other posts and updates when they're released. And if you'd like to give the paid tier of Free Market Speculator, including our popular Energy Bulletin Top 10 model portfolio, a test drive, I am offering 14-day free trials via the link below. In the EB Top 10 portfolio, we recommend the exact producer and services stocks to invest in the next leg of the energy supercycle. I'll see you next week for another episode of my Sunday Deep Dive.